Hello and welcome to Live Wire Markets. My name is Chris Conway. In this edition of Fund in Focus, I'm sitting down with Nick Griffin, the Chief Investment Officer for Munro Partners, to talk about the Munro Climate Change Leaders Fund, stock code MCCL. Nick, I understand the reason for investing in climate. It's a massive opportunity and it's important for the world, but why have you decided to wrap an entire portfolio around it?
So I think two reasons. Firstly and foremost, we think this is a great investment opportunity. From our point of view, if we just listen to what every corporate in the world is telling us, which they've effectively set net zero targets by 2030 or 2040 or 2050, then every single company we meet is investing to lower their carbon footprint. From our point of view, our job as growth investors is to follow the money to find where they're going to invest at, because that's a great structural trend. It's a structural trend that will last, we think, the next 10 to 20 years, as every corporate either fulfills or doesn't fulfill their target. So one, it's a great investment trend. And two, we think there's a lot of ideas out here that we think can double their earnings over the next 5 years, and that double of earnings will equal a doubling of share price. That's the first reason. And so we set up a standalone fund, one, just because I thought there was a lot of ideas to be found here, and I wanted us as a team to really look for them and find them. The second reason why we set it up as a standalone product is because ultimately there are people out there who believe in climate change and care about climate change and want to allocate their capital to best help it happen. And we would argue $1 spent in our fund means that it will lower the cost of capital to the companies that are actually doing this, because we will give it to the key enablers of decarbonisation. We're not going to give it just to ESG stocks, companies that are good corporate citizens, because they've already solved the problem. We're actually giving the money to the companies that are enabling decarbonisation. That will lower their cost of capital, and so if you invest in this fund, we think it's the best bang for your buck, so to speak, in terms of helping decarbonisation happen.
Nick, why the ETMF structure?
Look, the ETMF structure is just very good because you don't have any issues around the LIC structure. You don't go to a discount to NAV. Secondly, I suppose the simple way to think about it is the fund will always trade at its NAV, and anybody who buys the fund today, they buy, they execute, the ASX facilitates it, we set up the fund structure to do it, and then they wake up tomorrow and they own somewhere between 50 and 25 of the best decarbonisation enablers on the planet as chosen by Munro Partners. And so from our point of view, we think that's the cleaner structure for doing it. The second thing we just say is, we ultimately want to position this fund against the ETFs in the space. We think the ETFs in the space are good, but they're basically just taking an index of 100 stocks and saying these companies all claim to decarbonise, let's put them all in an index and let's invest. And so from our point of view, we think that our active management capabilities can outperform those ETFs. And so that's why we're going with a more concentrated, active managed style but is structured in exactly the same way as the other ETFs in the space.
Nick, let's talk a little bit more about the parameters of the opportunity. You talked about longevity being multi-decade, size, scale, diversity, dispersion. How do they all warrant the case for investing in climate?
Okay, so the size of the opportunity is ginormous. It's going to be somewhere between $50 and $100 trillion to decarbonise the planet. And it's going to be spent in all sorts of different areas. So that's $50 to $100 trillion over 30 years. And so that's $50 to $100 trillion of revenues to the companies that can help do this, or the enablers of decarbonisation. It's a very diverse opportunity. So you would meet companies, say Woolworths came in here and is trying to get its net carbon to zero, which it is. It will do that by making its stores more energy efficient, i.e. lighting, insulation, how they run the software that they use to run their stores. They'll do it with their fleet, so they'll do it with their cars, they'll do it with their trucks, and they'll do it with their purchases of renewable energy. They'll do it with how do they acquire more renewable energy. So this is a really diverse opportunity, covers a lot of different sectors and areas. And then the last thing I'd just say is, look, versus our other funds, which are probably more technology focused, the climate opportunity is more industrial focused. So you're really talking about companies that are making things and fixing things. So you've got a more industrial focus, and you've got more of a lower market cap focus. There's no mega caps in the climate opportunity like there is in technology. And so that's the best way to talk about it, I suppose.
Just one thread I want to pull on there, Nick, if I may. Will this be another example of a winner-take-most sort of scenario, like we've seen with tech?
It's a great question, and the answer is probably no. And so the reason why it's not a winner-takes-most, and the reason why the companies are smaller, is because digitalisation has network effects. So Everything's on Google, so everyone looks at Google, so everything's on Google, everyone looks at Google. There's only one search engine in the world. There's probably only 2 social networks, and there's about 4 video streaming platforms. So that's how tech works. Decarbonisation is different. It's a physical opportunity. So we're looking at companies that have established presences, like in heating, ventilation and cooling, or in insulation, and they will have competitors. That's fine. It just means their market caps are smaller, their multiples are cheaper, and they probably don't grow as fast as some of these tech companies, but it doesn't mean they're worse investment opportunities. It just means you need to look a little bit harder and understand the competitive dynamics a bit more, and most importantly, not pay too much for them, because they're never going to grow as fast as, say, these tech companies come. The climate opportunity will play out over a 10 to 20 year period rather than a 2 to 3 year period.
Nick, after considering all of that, where are you seeing the best opportunities right now?
Yeah, for us, it's really on this energy efficiency bucket and around industrials. So right now, electric vehicles is sort of boom bust, and we're definitely going through a bit of a bust in electric vehicles. They've probably pulled the demand forward, and things are slowing there. Conversely, energy efficiency is becoming really important. And so this is where we're quite focused at the moment. Why is it becoming important? One, because you've got this huge data center build out happening. This data center build out is happening at a time where the companies that are doing it are the ones with the most aggressive net zero targets. Microsoft's target is net zero by 2030, and then they even want to get the carbon back that they've put in over the last 50 years. Right. So the companies that are doing most of the building are the ones with the most aggressive targets, and that's really around energy efficiency. So from our point of view, that's companies that help build data centers, that's companies that help cool data centers, that's companies that do the insulation on these areas. We're also looking at insulations around commercial office buildings. Lastly, renewable power is very important here, so that's where we think things like nuclear energy and solar energy are super important. So from our point of view, it's really that energy efficiency bucket around industrials that we're most focused on at the moment, and that's where we see the most opportunities.
Is there a name within that bucket, Nick, that you could talk to?
There's a ton of them, quite frankly.
Yep.
But one of our best investments in the last couple of years has been Constellation Energy. We talked about this before.
We have.
This is the largest nuclear provider in the US. Nuclear is clearly the largest source of renewable energy on the planet today, and the largest source in the US. And it's increasingly being accepted. Again, I'll use the example. Microsoft has a contract with Constellation where they pay a premium to Constellation for power. Doesn't make any sense because power should be ubiquitous. But they pay a premium for renewable power to power their data centers so they can advertise to their customers that they're renewable. That's a good winner from this. Another good example here would be Schneider Electric, listed in France. This is a company that builds basically power architecture for every building, every data center, every auto plant on the planet. And so if you want to lower your carbon footprint, you want to lower the amount of electricity you're consuming, you want to talk to Schneider. They're going to provide you with the switches and the power within your building, but they're also going to provide you with the software to manage your building. And so this is just another really simple, good industrial company that's going to benefit from this shift, because before you're just trying to do it to keep the lights on, and now you're trying to do it to lower your power footprint. And so that's another good example out there.
Nick, how can investors use the strategy in a portfolio?
Yeah, so we would argue that they should use it as a satellite exposure. So we don't think you should use our climate fund as a replacement for your global equity exposure. We have global equity funds, and we think they're good global equity exposure. You should use this as a satellite exposure because you believe in decarbonisation like we do, and you believe in the opportunity. And secondly, you should use it as a satellite exposure because you want to direct some of your dollars that way to get the best bang for your buck in terms of helping decarbonisation happen. And so from our point of view, we're looking for people who think like us that this is going to be a great opportunity. And secondly, they don't think the ETFs are actually fitting the opportunity for them, and they don't think the ESG funds are fitting the opportunity for them. And they think the same way as us. They want to invest in the enablers. And what we're offering is 15 to 25 actively managed enablers of decarbonisation that are going to help solve this problem over the next 10 to 20 years. And we don't think that's mutually exclusive to getting really good investment returns. We think we're going to get really good investment returns here as well.
Nick, thanks again for chatting with Livewire.
Thanks very much for having me.